Over the past year, we have continued to highlight the promise and subsequent reality of China's rapid recovery from COVID-19. The just-released March quarter GDP print spotlights their success, with GDP at March reportedly 18.3% higher than a year ago. At this point, recovery is no longer an accurate description of China's progress, because GDP is 7% higher than it was in December 2019, before the pandemic. It could be argued from the subpar quarterly gain of 0.6%, however, that this strong growth cycle is ending abruptly. We do not believe this is the case for two main reasons. First, it must be recognised that the 2021 Lunar New Year celebrations were atypical, coming at a time when there were several small secondary outbreaks of the virus, and as the government discouraged migrant workers from returning home to celebrate with their family. Consumption in the March quarter was therefore biased downward. Second, available partial data makes clear that China's economy continues to carry strong, broad-based momentum. Despite the restrictions imposed on consumption this Lunar New Year, at March, retail sales were still more than 30% higher than a year ago, with some large household items such as appliances and furniture up 40 to 50% versus a year ago. Fixed asset investment also continues to show great strength across an array of industries. And credit in the first 3 months of 2021 was 19% higher than at the same time in 2019, providing both the public and private sectors with ample funding for existing and new projects. Note there is also strong justification for investment in new capacity, with a robust new order trend apparent as the global pandemic recovery accelerates. We're not only confident about China's prospects for 2021, for which we are forecasting a year average gain of around 10%, but also into the medium term when we see GDP growth sustainably between 5.5% and 6%. What allows for such an outturn is economic policy focused on productivity and efficiency through investment. Importantly, unlike the US, strength in China's consumption is to be pursued as a consequence of income and wealth gains, not stimulus checks. Helping to capture maximum benefit from this economic development, authorities are prioritising funding for investment that will either help to develop new and expanded export markets, or which aim to stoke growth in Chinese consumer businesses to compete against imported goods and services. The more of China's income that can be kept in country, the faster they will build wealth and capacity for future economic development. To these expectations, there are two clear risks: trade restrictions and financial stability. With regards to trade, while tense, the relationship between the US and China is unlikely to deteriorate further. Both sides are willing to talk, as they know what they stand to lose. For China, long-term trade opportunities in the US, Europe and elsewhere cannot be put at risk. China also stands to benefit materially from opening up their economy to Western firms. From the US's viewpoint, access to China's consumer market holds immense promise. On financial stability, while authorities' tight rein on credit provided by non-banks, particularly peer-to-peer lending, is a material headwind for many small and medium-sized businesses looking to scale up, it will protect these vital domestic employers until inappropriate lending can be safeguarded against. In the meantime, the focus the banks have on quality lending to larger firms with strong prospects will bear considerable fruit. We'll see you next time.